All right, everyone, give me a minute. I'm actually trying out a new platform today for these conversations in StreamYard, which everybody says I should be using to begin with. This will be a good conversation with the folks at Dynamic Wealth Group. Going to be talking about some things which are going to probably be sobering, but I think are important to talk about when it comes to valuations with Brad Barrie and Matt O'Bryon. This conversation is sponsored by Dynamic Wealth Group. We'll be talking about what they do as a firm as well as their fund. And we're going to talk all things tactical here. Now, whether you're watching this on X, on LinkedIn, on YouTube, wherever you're watching this, I can see your comments. I can see your posts. Let's make this interactive, which means that if you want to engage during this roughly hour-long conversation, post on whatever platform you're seeing this on. I'll bring it up. Be a good back and forth here. With all that said, my name is Michael Guyette, publisher of the Lead Lag Report. Joining me for roughly an hour is Brad Barrie and Matt O'Bryon of Dynamic Wealth Group. I want to have each of you quickly introduce yourselves, your background, and then let's get right into the sobering reality of markets today. Brad, I'll start with you.
Yes, thanks, Mike. So Brad Barrie, with the Dynamic Wealth Group. Dynamic Wealth Group, we run a mutual fund, Dynamic Alpha Macro Fund. Ticker symbol is DYMIX, and we also run an OCIO, an outsourced chief investment officer service for financial advisors. I myself was a financial advisor for 20 years in the Chicago area, and worked with people, helping them plan for their goals, invest their money, and now we are kind of turned from an advisor to individuals to an advisor to advisors. Is kind of what I view my role. So I could probably go on for hours, but I don't want to put people to sleep. It's too early in the day for that. So.
Yeah, and I also work with Dynamic Wealth Group. Brad mentioned our business, and I've been in the business for about 15 years. My background being more on the support side and supporting advisors in building models, home office models, trading, that whole side of things. So more on the investment analysis background.
We're going to be talking about tactical and alternative investing, which has a cycle, believe it or not, and we may be nearing that cycle finally after all these years. But you had sent me, Brad and Matt, a series of slides, which I'm going to show, which I think are important for people to look at. We're going to talk through it also for those that are listening on the audio-only version of the podcast. And I think it'll be just sort of enlightening from a lot of perspectives. And this is not from the standpoint of thinking about things from a point of view of being bearish for the sake of being bearish. It's more about context in terms of where we are in a cycle. So I'm going to have you, Brad, and Matt, if you want to chime in, obviously, kind of talk through some of these slides. I'll add some questions here, but let's start with this one, looking at good old price to earnings.
Yeah, so the first chart is good old price to earnings ratio, going back about 35 or so years or so, and I think the chart speaks for itself. You can see that, current data, PE is about 22.1. Historically, that is relatively high. The rest of the slides kind of support this message of valuations are potentially at a peak. Now, part of our philosophy on investing is preparation over prediction, right? And always be prepared. Versus trying to predict 100%. Nobody can predict 100%. We all know that. Doesn't mean you shouldn't attempt or you shouldn't be aware. But this is telling us something that is pretty evident, that based on a price to earnings ratio, we're pretty high. If you jump to the next slide, it's a variation of the PE ratio, which is the Shiller PE ratio, which is just a different way to look at valuations, is also at a relatively high point. And this chart is actually over what is that? Almost 100-year time frame.
It's 100 years.
Yeah, 100 years. So certainly we've been higher, but we're not many times. This might be the third highest we've had the Shiller PE. If you jump to the next slide, it also supports this kind of illustrates it with 5 different valuation metrics. So this is showing averages with the range of those valuations since 2003. The first chart shows the PE with the historical range. It shows the price to book at the historical range, price to sales, price to cash flow, and dividend yield. And to describe it, it shows a box with kind of the high and the low. The diamond, the kind of dark diamond, is where we are today. And if you notice where we are today, even just a year ago, where the red X is, pretty much high for PE, over the range for the price to book, and same with all of them, right? So valuations are telling us we're pretty high relative to various ways to measure valuation. Jump to the next slide. Is probably one of, the next one's probably my favorite one. But this is a good one too. This is just showing leading economic indicators. This one shows
Real quick, Brad, if I could jump in, if you can go back a couple of slides, Mike. I just want to, for the audience that's just listening and not viewing the slides, go back to the first two slides if you don't mind. I just wanted to give them as sort of examples here. So just so people are seeing, so going back to essentially the mid 80s to today, we're at essentially the third highest peak on the PE ratio. Essentially, the only two higher peaks are essentially right after COVID. I think we peaked right around 23 times earnings coming right out of COVID, and then the tech bubble at 24.5 times. So essentially, the only two times we've seen price to earnings ratios at this peak are right before the tech bubble popping in 2000 to 2002, and then right after COVID, right? The stimulus hitting and just everything, reopening, and the reopening trade coming out of COVID. So, again, the historical average over this time is about 15.5 times is what this chart shows. And again, price to earnings has been beaten now. I'm a value guy. I talked about this on the last time we were here. Price to earnings by itself does not dictate where the market's going to go or what's going to happen in the future. This is just us sort of taking a temperature of the market and saying, where are the risks and what can this tell us about what might be, where are the risks? Are they to the upside or the downside? And there's a lot of things that have been theorized about, do we have a reason why these might be persistently higher going forward as to where they are? If you go to the next slide, actually, Michael, great. This is perfect. So this is the cyclically adjusted PE, as Brad mentioned, the Shiller PE. So this is adjusting for the economic cycle over time. So it's divided into basically two regimes here. The average before 1990 and then the average since 1990. And the reason they do that is because essentially post 1990, you're taking in sort of the tech boom. And so it accepts that there might be two regimes here, right? You have the industrial age where you might have a PE ratio of X. And then on the technology age, because things are so much more efficient and we can have growth rates that are higher, it might need to be 2X. And it's actually works out to about 2X. So before 1990, that's Shiller PE averaged about 14 times. And since 1990, it's been about 26 times. Right now, we sit at 36 times, which is, again, fits basically with what the standard PE shows as the third highest on record following the 2000s and the post 2020 bubble. So,
and presumably this is why we've been seeing more and more of these large institutions arguing that S&P returns on a 10-year forward basis might be like just 1% annualized, right? It's the starting point of the valuation is the issue.
Yeah, I think that's. I mean, I think there's one investment house you're probably thinking of in particular. We won't name here, but yeah, I think that's where they're coming from, and it's based on this indicator we're looking at right now, right? Just saying, with this as the starting point, things don't look so good. And if you skip ahead a few, Brad, I think this is the slide you wanted to go to. It's the regression analysis, right?
Mm-hmm.
A couple more, actually. One more.
Yeah, the next one.
Yeah, this one. This is exactly that story, Brad. If you want to, you can go ahead and dive in here.
Yeah, I mean, so you may have seen this type of chart before. So this, again, is a scatter plot. The beige colored squares, diamonds are 1-year returns following the subsequent. So on the vertical, you have forward annualized returns, and the horizontal, you have the PE ratio, right? So each of those brown squares represents the 1-year return after a PE ratio of that metric, right? And you can just look at those and see from a regression analysis standpoint, there's really no rhyme or reason. The vertical dotted line roughly at the 22 mark on the PE is where we are today. So if you look historically, the 1-year returns from where our current PE ratio is can range anywhere from 25% positive to negative 25% positive from a historical standpoint, right? Doesn't really tell us a lot. The 10-year forward returns, however, are relatively telling. You can definitely see a regression analysis, a pretty strong regression downwards. The higher the PE ratio, the lower the historical 10-year return from that point. So at the current point, historically, it's anywhere from up a few percentage points to down a few percentage points, right? That is potentially worrisome. Again, this is based on history. Nobody has a crystal ball. Anything can happen over the next 10 years, but this should give pause and caution based on current valuations. And again, over the next year, we could have another double-digit positive return over the next year. Anything is possible. But at the end of the day, valuations matter. And again, our approach is to not just pinpoint one data point or one analysis and say, oh, this is saying we're going to be overvalued, so let's hunker down and short the market and what have you. No, anything can happen. It's about being tactical. It's about being active. It's about being diversified. And we touched on this a little bit last month, but diversification is probably an overused word and probably not appropriately used. The way we view diversification is not just having a bunch of different stocks and a bunch of different bonds. We call it multidimensional. It's having a bunch of different stocks, a bunch of different bonds, buying and holding for the long run, but then also having some tactical approaches, also having some alternative approaches, so that you have different, we call it drivers of return, right? What can you identify in your portfolio? What's going to drive that return? And if everything is driven by economic growth, and if we don't have economic growth, whether that's small cap, large cap, international, private equity, it's all largely driven by economic growth. So we worry sometimes that investors or advisors aren't kind of looking through the fog, so to speak, to see what they truly have from a driver of return standpoint.
And I think one of the slides you have covers that, or maybe I'm mistaken. This one's an interesting one, looking at equal weighting versus market cap weighting. Talk through this, because I think this is, to me, the most important asset allocation decision if you have to be exposed to core equities. Do you want to be exposed market cap weighted or equal weighted going forward?
Yeah, this is a good one, right? Because everyone talks about the decision to be, are you passive, are you active, and where are you in the spectrum, right? We have this with our OCIO clients. Someone asks, do you want to build us a passive model that's all ETFs? And then they say, well, should we include some value or growth? And it's like, well, okay, but what is passive? Are we just passive versus the S&P? Are we passive versus the world? Are we passive on a market cap weighted basis or an equal weighted basis? So the chart that we're showing now is just if you took the S&P 500 and then you compared it to if you just took the largest 50 names in the S&P 500 versus an equal weighted version of the S&P 500. And it goes back to 2019. And what it shows is that something that I think everyone inherently knows over the last 5 years, that the largest 50 names in the S&P 500 have outperformed the market cap weighted S&P 500 pretty substantially, 170% versus 134%. And that's as of November 15th is when this data is as of. And then if you look at the equal weighted S&P 500, which is just all 500 names weighted at 0.2%, it's only returned 98% over that same time frame. So almost 36% underperformance versus just the market cap weighted, and almost 72% underperformance versus just the largest 50 names, basically being driven by those top 10 names in the S&P 500 that have gotten all the publicity over the last 5 years. So it speaks to the large and mega caps just driving the market over the last few years. One of the interesting things in, I think, the same research article we were talking about is they highlight that the equal weighted S&P might actually outperform the market cap weighted S&P 500. And part of that is those valuations are primarily driven by the higher valuations of the mega cap stocks in that index, the NVIDIAs of the world, as opposed to some of the lower components of the S&P 500. Excuse me. So it is interesting to look at. I know you. So it's not a trade like we have on, or it's something we're recommending, but it is an interesting trade when you look at how tactical do you want to be, and are you being passive? Are you being active when you just pick an index and just picking, ACWI versus, US, or do I pick the Russell versus the S&P? Do I pick the Russell 3000? Do I pick a weird index that might incorporate things differently than just the S&P 500 as a market cap weighted index?
I will say the really interesting thing, at least from my vantage point, is the gap converges, whenever you have those major drawdowns, meaning
sure,
the thing which has led on the way up is the first thing to get slammed the hardest. And, you go back to sort of the equal weighting, then you expand, and you collapse and you expand.
Well, if you go back to like the tech bubble, I mean, the way a lot of again, it's my history of studying value managers, right? The way a lot of value managers got through that time frame was being small cap and being value oriented, right? Even just avoiding the mega cap tech names again in that same time frame, right? The ones that have run up the most and built the most in their cap, like those are the ones that usually get hit the worst. So yeah, I mean, if you look at this, it's the names that run up coming out of 2020 that got beat up the most in the teardown in 2022 and 2023. So I think this is inherently a chart that probably most advisors and investors felt, but maybe didn't necessarily think about, because no one's talking about the names in the bottom of the S&P 500. Everyone talks about the names at the top.
They'll say it's a feature, not a bug, of market cap
sure.
weighting, right? And I'll go back to, well, if you have performance this outsized from the largest 50, and that's what's largely driving the market is no longer diversified.
It's an interesting point, and we've talked about that because we run a mutual fund, you run a mutual fund. By law, by prospectus, in order for a mutual fund to be called diversified, it cannot have more than 5% in any one individual holding. So there's an exclusion for index funds in that term, but by the core definition, the S&P 500 is not diversified because it has a number of holdings that are over 5% allocation. So again, it's an interesting nuance that is also, you're very right, because you even just chart, you can look at the January 2022 point, you see those largest 50 kind of diverge from the equal weight in the S&P, and then sure enough, they kind of converge, they kind of merge back together. So, but yeah, it's an interesting point. A lot of people don't realize the S&P 500 by definition is not diversified.
It's a concentrated fund. Yeah.
Yeah.
And in fairness, it's worked, right? In fairness, it's worked, but
everything can work.
Right.
Everything works until it doesn't, right?
Yeah,
and
exactly.
And again, I've been in the business since the late 90s. I lived through a number of bubbles. We can identify, and I'm not saying we're in a bubble or we're not in a bubble. I'm just saying we can identify bubbles when they are, and bubbles can keep growing for many years, right? But and again, that's where we would argue being tactical, having alternatives in a portfolio, utilizing a strategy can really come into play. So, Mike, I don't know if you can share the other slide deck, the other PDF that kind of touches on, tactical time in the market versus timing. So a common phrase used is it's the time in the market, not timing the market. And that is certainly true, right? Holding an investment through longer time frames will almost always yield you better, longer, adjusted returns. And this is data that has been shown many times to investors and advisors. It shows, we ran this from 1990 to end of October this year. If you just bought the S&P 500 and held it with $100,000, you'd have almost $3.3 million in it. If you missed just the 10 best days, your return goes from 3.3 million about to 1.5 million. Then if you miss the 20 best days, you go down to almost 900,000. So this is the argument that is commonly made in the industry for don't try to time the market. And look, if you don't know what you're doing, absolutely don't panic, right? It's one of the things. So I do a weekly, bi-weekly YouTube video. I post on LinkedIn. It's only about a few minutes long, kind of on current events where we see, and I always end it the same way, thanking everybody for watching and encouraging them to make smart, logical, and fact-based financial decisions. Emotional decision making can really cause havoc on a portfolio, on a financial plan. Again, having been a financial advisor for roughly 20 years, I saw that firsthand, and it's tough, right? It's one of the core jobs of a great financial advisor is almost that of a psychologist, to have to, and an investor as well, understand your own psychology as an investor and understand your comfort level and your temperament. Sometimes I use the term spicy, right? Because although I like spicy food, I can't eat spicy food. So my tolerance for spiciness is really low. Somebody else's tolerance for spiciness might be really, really high. So this is commonly shown. If you show the next slide, though, because one thing I always asked myself when I saw this data is, what about the flip side? And this is something you won't see as common out there. So what this chart is showing is it's adding 2 additional bar graphs showing, instead of missing the 10 and 20 best days, what if you missed the 10 and 20 worst days? And if you miss the 10 worst days, your return from the S&P goes from about 3.3 million to 7.9 million. If we were in a group and we're running a little poll, I'd actually probably ask people to guess what those numbers were. And most people wouldn't guess that it would be that high. And if you miss the 20 worst days, your return goes up to over $14 million from just the buy and hold of 3.3. Now, we're not here to tell you we can, or Michael, you can time it perfectly, and we're gonna stay in for the best days, and then we're gonna miss the worst days. Nope, not possible. In actuality, a lot of those best and worst days are right after each other.
Okay. Thank you for saying, because I wanted to go into like, I've done a lot of studies on this myself. And that's what's missed about a lot of these studies. It's the volatility clustering. So big downs tend to be followed by big ups, tend to be followed by big downs. So to your point, they tend to be close to each other. They also tend to occur usually when you're below a very long moving average, right? So the extremes on the up and down tend to, for example, happen more often under a 200-day moving average on the S&P 500 versus above it.
Yeah, it's the bottom in 08 where you're down 5% one day, and then the next day there's optimism and you're up 8% the next day. I mean, like looking at the daily data sets and looking at because I pulled these numbers the other day, and so like looking at the days where you had the 10% up day, it's in October of 08, right? Like, I mean, these are the time frames you're talking about, and when you see it there. But I think to Brad's point, it's like they do cluster together, and so practically it's hard to be either of these, right? It's hard to just miss the 10 best or just miss the 10 worst, which is why we have the next slide, right? Because a tactical strategy is probably going to miss both of these, right? So if you could show that.
And that's okay. That's by design, right? And that's where, again, it can be misleading just to show the first set of data and think that, just buy and hold always works, and I should just buy and hold. It can work in the long term, but what if you need distributions? And what if you're not wanting to ride a roller coaster with your retirement savings, right? So this slide shows, again, 2 more bar graphs that shows, instead of just missing the 10 best days or missing the 10 worst days, what if you miss both, right? And you miss the 10 best and worst days, and then you miss the 20 best and worst days. What you see is the returns are slightly better, from 3.3 million if you just bought and hold to about 3.6 million if you missed the best 10 and the 10 best and worst days, and then about 3.8 million if you miss the 20 best and 20 worst days. So again, that's what we view tactical management, what diversification should hopefully do, is give you about the same return as buy and hold, maybe a little bit better over time, which is what this shows, but most importantly, with less volatility. That's what we strive for in the mutual fund that we manage. That's why our mutual fund, and we talked a little bit about it last month, our mutual fund combines buy and hold stocks. And this is something that, again, as an advisor, I always dealt with clients, where we would look at maybe a few different investment options, and maybe we're looking at investment A and investment B, and do I choose investment A, or I choose investment B? And in so much of our society, we think that we're binary. You have to choose one or the other. No, you don't. With investments, you don't. You can do both. You can put a little bit in A, a little bit in B, maybe a little bit in C, D, and F, right? You can do multiple. And that's what our mutual fund does, is half our mutual fund is buy and hold large cap core US stocks, because we know over time that that's going to work. But the other part of our mutual fund incorporates tactical management of a global macro futures strategy. So it gives access to markets above and beyond just stocks, right? Again, we all love to refer to the market as the S&P 500, but that's part of the market. There's also a cocoa market, a copper market, a gold, silver market, which, Michael, I know you have passion around, the gold market, and as do we over time, as a diversifier. And that part of our mutual fund, that 50% that is global macro long short futures exposure. So it follows other markets, and it can be tactical in those markets. It can go long or short gold. It can go long or short copper or cocoa, and the futures market, basically. So that's our approach in our fund. In our OCIO, when we build models for advisors, that's incorporated as well. But the need for tactical management and the reason for it, I think, is important to understand, so that investors stay in it long term. Because at the end of the day, that's why you invest in something, is the reason for it.
Yeah, I didn't hear you mention the ticker and the name of the mutual fund, but let's do that for those that are listening for the first time.
Yeah. So the name of the mutual fund is the Dynamic Alpha Macro Fund. Everything we do has reason behind it. So the name of the mutual fund is very logical. We're dynamic, we're tactical, we're searching for alpha, outperformance, and we're doing it on a macro standpoint. So macro meaning big picture economics, right? We're not as concerned, is Apple going to do better than Google, is better going to do Microsoft or Nvidia. It's more macro top down. The ticker symbol is DYMIX. We affectionately refer to it as DYMIX, DYMIX. Available at most retail firms, Schwab, Fidelity, Pershing, as well as most advisors as well. If advisor does not have access to it, please reach out to us, and we'll work with your firm and back office to show interest to get it on your platform.
Just going back, one of the things I think Brad hit on was the idea that clients and investors can only take so much volatility, and that's one of the things that tactical management is really designed for, and what diversification is really designed around. And I think Howard Marks really summed it up in one of his letters years and years ago. I think it was maybe 8 or 9 years ago I read, and he talked about it as mental capital, right? You have this pool of mental capital you can expend. And after so long on drawdowns, like I remember having calls like during COVID, right? During the drawdowns in COVID, where a client would call and just say, how many more days of these drawdowns are we going to have? Like, I need to get out. I just need to go to the sidelines. And it's like, there's no reason to like fundamentally, you are a 35-year-old man. You are a 38-year-old man. Your money is in an IRA. You are not going to touch this money for 20 plus years. Like, what are we doing? If this was 2008, your money will recover within the next 5 years. Like, logically, there's no reason, but he had expended all of his mental capital because the drawdowns just wore on him. He had spent too much out of that pool because the drawdown was too bad. And so it's easy going in, especially after, the 10 years prior to that, coming out of 2008, which was probably his formidable investment experience, was pretty much straight up, right? You had a little blip in 2018, a little 10, 15% drawdown in 2018. But other than that, he started in the European debt crisis, and his entire career was 20% every year. And it's all gravy, but that's not how markets generally have worked in history, right?
See, I like when managers get started in hell, right?
Yeah.
I mean, it's like, and I'm actually because so much of one's understanding of markets is a function of when they start, and I think it's actually better to start when things are going to shit, right? Than otherwise.
2008.
That's how you learn. That's how you learn. I mean, it's during the lockdowns, a lot of people got money and they invested it, and they thought, well, this is easy. This is easy. I just have to buy any stock and it goes up. Buy the dip, it goes up. And it did then. It doesn't always, right? Sometimes, again, one of the catchphrases, is don't try to catch the falling knife, right? And eventually a falling knife will turn around and go back up, but it could keep going lower. And look, one of the things, I reiterate with Matt, what he just said on investors, again, I realized it as an advisor because I saw my clients go through it, and I thought through it. If you just think through it, as human beings, we're kind of hardwired to think that way. We're hardwired to think fight or flight, right? And I go back to the caveman days, right? And during caveman, dinosaurs chase, and I know I'm not being accurate. Dinosaurs and cavemen weren't around at the same time, but right, if you're a caveman and a dinosaur is chasing you, we're hardwired as humans either fight or flight, to flee.
We're also hardwired to herd. When the woolly mammoth, right, is coming out, right?
And with investing, fight or flight is really not what you want to do. You don't want to flee when it gets tough, and you don't want to try to fight it. You need to have rules. You need to have an approach. You need to have discipline. And that's why, again, nothing wrong with tactical. You need tactical, but you need to do it with an approach, not just, oh, the market's down, I'm going to panic, right? So by having those tactical managers, those alternative strategies in the portfolio, though, that's what's causing, hopefully, that smoother ride, that smoother equity curve that will help people stay invested for the long run.
But to Michael's point, it's like constantly throughout that, you have to fight that herding mentality, right? Of in a bull market, it feels like, oh, everyone else is up 25%, even though they're probably not, right? Like, very few people are owning just the S&P in their portfolio.
I hate to say this, but I don't think many people even know how to calculate holding period returns.
No. Oh, God, no.
I mean, that's a whole conversation for another day.
You want to open up the Gibbs manual? I'm here.
Hey, man, on a side note, I was, I remember, if you remember Ashland Partners, Mel Ashland, with my father's RIA, they were actually one of their first clients with Ashland Partners back then. So, and I know all about the Gibbs side, right? Even before I had my CFA charter. There's so many nuances which are just fascinating about that. But no, and the other part of this too is this is why it gets to be really interesting, I think, when you're in a prolonged cycle like this, where it's buy and hold, just going to the S&P. Because what happens is tactical managers need a cycle where they can really thrive. Typically, that cycle involves volatility, to your point, Brad, about missing the 10 or 20 best days, worst days. And if they don't get enough of those volatility pulses and fear trades, what happens is they can't raise assets because the performance usually doesn't look that good against the S&P 500, and everyone compares against the S&P 500. The end result of that is that over time, there are fewer and fewer of these active managers in the marketplace because they can't survive. They can't raise assets. They don't have the shiny object moment for performance chasing to get them more fees to stay in business, which then only means that for those that do survive, that have good performance, throughout a cycle that is not exactly favorable for their tactical approach, they become the real winners because there aren't that many places to position tactical money because there aren't that many traders left.
Whenever we come across a really good tactical strategy that has like a track record and has stuck by their guns through the last 10 years, and it feels a little different like the last 4 years, I'd say, because to your point, we had COVID, right? Which to be fair, COVID's a trickier tactical thing to manage around because no one had that. I don't feel like there's anyone that had that on their radar, right? Like, like you can say there are people that got managed around, the GFC well, or managed around the tech bubble pretty well because valuations were a signal, or, they just were tilted towards quality and they didn't have financials in 2008 or whatever it might have been. It was pretty hard with COVID. You either stuck by your guns and you said, hey, things are going to be okay, and I just didn't sell out, and you worked out, or you did and you got whipsawed and you got killed. But you had COVID, and then you had 22, 23. So you have had those sort of two volatility periods inside of 5 years, which sort of is that window you're talking about. But that's the first one since basically like 95, 94 and 2000. I mean, like that's the closest to that you have before then. So you have basically like a 20-year period where you've basically been absent of that. It's really hard, and I don't know of a lot of really, really good tactical managers that have succeeded through that whole window. I think you're starting to see more pop up and sort of refreshing that, but it's, my generation of investment analysts and investors that have come up, like, I think they've sort of shut out this side. And I've encouraged people my age to like keep listening, keep giving them a try, because it's not going to be the way it's been for us the entire time. It's just not.
It's just that you and I both know that that's hard for people. Can intellectualize that and say they understand it, but that lizard part of the brain, right? That FOMO, that I just want to go, and buy the chart, right, on the S&P 500, And the funny thing is, like, most people make a decision based on a chart, but most so-called technicians underperform, right? Which tells you right away why this industry is so maddening from a product perspective. On the mutual fund, you talked to a lot of advisors, talked to a lot of different types of investors. You've got the blend of the buy and hold with the tactile. Because you already have that sort of anchor on the buy and hold side, it seems to me that it can be maybe a larger portion of a portfolio than other alternative type of strategies. If that's the case, what typically is sort of a range that you've seen others, use to allocate with?
Great. It's a great question. We've seen, you are 100% right. We do see advisors use it as a larger percentage versus what they would an ordinary quote unquote alternative fund, because of our structure, because of our target. We've seen anywhere from 20% or so on the more aggressive side of a portfolio to, even for a quote conservative portfolio that is, almost all entirely bonds, we've seen 5 to 10% allocations work in there because our strategy has been shown to be non-correlated to both stocks, bonds, as well as other alternatives. We do invest in futures, but we're not what would normally be thought of as a managed futures strategy. Managed futures is generally trend following, algorithmic trend following, and that's not what we do at all. And that's okay. And again, that's by design. That's one of the reasons we chose to launch the mutual fund, is there wasn't a lot out there doing what we're doing. So we pair very well within a diversified portfolio, and we see people take from their stock allocations, their bond allocations, their other alternative allocations, put into our mutual fund and have it be complementary towards everything, right?
Yeah, I think that makes a ton of sense from that perspective. Again, it's like you mentioned it before. It's, sure, valuations are elevated, but that's not to say the S&P couldn't be up another 20, 30% next year, or the year after that, or the year after that, and in the 9th or 10th year, right? It undoes all that, right?
Yeah.
The sequence of returns is often what's missed when people think about this stuff.
Yep. And look, I mean, there's the old saying, right? The market can remain irrational longer than you can remain liquid. So I'm not here to fight what the market does. We're not here to do that. It's just the cost of being diversified. If a diversified portfolio underperforms by 1 or 2% in a year and the market's up 25% and we're up 23%, that's a cost we're comfortable with. If on the downside, it means that we're more than protected against a major drawdown, right? Like if it means we can see 60 or 80%, versus the market, right? Like on a drawdown basis. So like, it's just figuring out what we're comfortable with giving up on the upside to be able to sleep at night. So like, that's really the gist of it, because yeah, I mean, look, if you go back to 2011, 2012, how, again, going back to my value hat, putting my value hat back on, how many value managers saying there's nothing to buy? And then we had 20% years stacked one over another. And you just can't sit on a 20% cash pile all that long. And valuations for valuation's sake just doesn't make sense anymore. There's plenty of arguments that make a lot of logical sense as to why maybe that average valuation, that average PE does need to be stepped up. Maybe the next generation of capital efficiency means that, the PE ratio does need to be in the high 20s, going forward. I don't know. I'm not here to say that. That's going to be determined by academics 10 years from now, 15 years from now, 20 years from now. What I can say is historically we are at an elevated PE, and historically that doesn't lead to good forward 10-year returns. And so putting a little, having a little bit of a safety rope on my back feels pretty good. So if that means owning a little bit of extra, alternatives in there, or a little bit of extra hedging in there, that is a bit of a headwind for me to fight, I'm pretty comfortable with that overall. And that's how we think about it, not in oh crap, we need to build cash because the market's going to collapse in the next 2 years. That's not how we build portfolios. We can have managers that might be more tactical and might be more in and out of the market, but we manage their position sizing in such a way that it's never going to be detrimental to the overall portfolio.
Yeah, and it's one of the things I view it as giving our investors and giving your clients and giving your portfolio a fighting chance. If all you do is buy and hold stocks and bonds, you're on the roller coaster, right? And if you have, so within our fund, again, part of it is just riding that roller coaster. Half our fund is buy and hold stocks, but then the other part is giving our investors a fighting chance by looking beyond stocks and bonds. We have positions on the sugar futures now. We have position on feeder cattle. We've had positions in the past on coffee, on metals, on gold and silver, and the depth of market that's out there is so much more than stocks and bonds. And being able to go long and short these different instruments is what's adding that diversification, which can help if the stocks continue to run up, like we've said, and like Matt said, yeah, we'll make money on that other half of it. That doesn't mean we'll lose money on the other half, right? If our tactical calls on gold on those futures markets, be it gold or silver or palladium or cocoa or whatever, if those are accurate, then we'll make money on that as well, right? So our website, which is under my name there, right next to my name, dynamicwg.com, you can go there and you can view our fact sheet on our mutual fund, and you can see our performance. And our performance, I know we showed it last month on our talk with you, Michael. We've beaten the S&P 500 as of the end of last quarter. And we won't always beat it by any stretch, but over time, that's our objective. And it's our objective to do that with hopefully lower downside volatility and non-correlation along the way, which that's what makes it additive to a portfolio.
Yeah, big fan of the work that you guys do. Everybody, please make sure you go to dynamicwg.com, learn more about Dymex. Hopefully, those watching found this actually be a little bit of a better experience than I would have been using before on the other platform. I'm glad this worked out, given that it's the first time I'm doing this stream using this service. This will be an edited podcast under Lead Lag Live. Again, this conversation was sponsored by Dynamic Wealth Group. Learn more about their fund again at dynamicwg.com. Thank you, Matt. Thank you, Brad.
Thank you, everyone, and hope everyone has a wonderful Thanksgiving coming up next week as we're taping this live. And we're very thankful for you, Michael. We're very thankful for all our investors and advisors we're lucky enough to get to work with. And just a quick plug for Giving Tuesday. Everyone celebrates Thanksgiving and gets together, but Giving Tuesday is a wonderful opportunity to give to the local organizations and nonprofits. We're big supporters of that ourselves, and just encourage everyone to be cognizant of Giving Tuesday.
Thank you, buddy. Cheers.
Cheers.
You too.